Welcome. Before starting, I want to give a warm welcome to all of you and sincerely thank you for coming to watch the video today.
Yeah, absolutely. Thank you so much for joining us. We have some really fascinating material to get into today.
They really do. Today, we are breaking down the Sumitomo Chemical fiscal year 2025 third quarter earnings call. And, if you have ever tried to listen to one of these earnings calls, they can sometimes feel like this impenetrable wall of numbers.
Oh, totally. Very dense.
Very dense. But our promise to you today is a clear, totally jargon-free translation of those numbers, helping you understand exactly how this massive global company is navigating a really complex economic environment.
Right, because when you look at a legacy chemical giant like Sumitomo, you are essentially looking at a bellwether for the broader global economy.
Exactly.
They make the foundational materials for everything. So their performance gives us a sneak peek into the health of multiple industries all at once.
So let's jump right into the big picture of the presentation summary. The headline numbers here are wild. When you look at the top line, sales revenue is actually down. It dropped by 198.5 billion yen year on year, totaling 1,706.3 billion yen.
Which is a huge drop in volume.
It's huge. But the profits tell a completely different story. Their core operating income absolutely rocketed up by 126.8 billion yen to reach 186.8 billion yen, which makes you wonder how.
Yeah, how do you sell less but make way more? Synthesizing the core drivers here, this huge profit jump wasn't just magic. It was driven by three main pillars.
Okay.
First, Sumitomo Pharma saw incredibly strong sales, specifically for the drugs Orgovyx and Gemtesa. These are high-margin products.
So replacing bulk sales with highly profitable pharma sales.
Precisely. The second driver is major structural reforms. They are actively trimming the fat. And the third is massive gains in the essential and green materials segment, which was really driven by the partial sale of Petro Reba shares and better trade terms.
That makes a lot of sense.
And just to provide the financial context nuggets to ground this, the average exchange rate was 148.7 yen to the US dollar.
A weaker yen definitely helps their export profit.
Exactly. And the naphtha price was 65,000 yen per kiloliter. But really, point out the balance sheet here, it's getting so much healthier. Their debt-to-equity ratio, or DE ratio, improved from 1.2 down to 0.96.
Wow. Getting under that 1.0 mark is a huge milestone.
It really puts them on solid footing.
But let's pivot to the guidance and kind of the catch here. Because net income was 87.4 billion yen, which actually already beat their Q3 forecast.
Right.
But we have to warn you that the company expects a heavy concentration of non-recurring losses to hit in Q4.
Yeah, that is the catch. They're going to take a bunch of impairment hits. But to conclude the presentation summary with the good news for investors, the full-year core operating income forecast was actually revised upward to 200 billion yen.
Despite those Q4 losses.
Exactly. Plus, the company is increasing its year-end dividend to 7.5 yen per share. That brings the annual total to 13.5 yen, with a payout ratio of about 40%.
That is a very solid reward for shareholders. Okay, let's transition smoothly into the Q&A session breakdown. This is where the analysts pressure test the company's presentation, and we are going to walk through this sequentially.
It's always the most revealing part.
For sure. So for question one, we have the analyst, Mr. Watabe from Morgan Stanley MUFG Securities. To give a brief summary of his question, he asked about the Agro and Life Solutions segment. He wanted to know why Q3 saw a profit despite low sales, what the regional differences were, how inventory adjustments are progressing, and why the company expects a profit decline in Q4.
Right, so the company's response was that shipments were actually strong in Japan, India, and Europe.
But South America was the issue, right?
Yeah, South America struggled due to droughts and credit concerns. Also, the stronger yen impacted their export income. As for inventory, they said it is improving in the US and India, but South America still has excess.
And what about that Q3 profit spike?
Crucially, Q3 profits spiked because customers placed Q4 advance orders early. It was a pull-forward effect.
Ah, so they borrowed from the future.
Exactly. Consequently, Q4 profits will drop because those sales were already realized in Q3, combined with the general trend of declining sales prices.
Got it. Okay, question two. The analyst's name is Mr. Yamada from Mizuho Securities. A brief summary of his question. He requested details on the ICT and Mobility Solutions segment for Q3, specifically focusing on semiconductor resist performance, the memory market recovery, and future trends heading into Q4.
The company's response here was very positive. They said the semiconductor market is gradually recovering, DRAM utilization is increasing, and NAND is recovering.
That is a great macro signal.
Definitely. And they noted that while South Korean usage varies by generation, new plants in Taiwan and China are actively boosting logic usage. For resist specifically, U.S. capital investments are driving strong sales.
And what about Q4 for this segment?
Notably, the company confirmed that, unlike typical seasonal trends where Q4 usually declines, they expect this strong performance to continue right through.
Defying gravity. All right, moving to question 3. The analyst is Mr. Miyamoto from SMBC Nikko Securities. A brief summary of his question is that he was following up on the Agro and Life Solutions math. He asked for clarification on why the volume variance was negative, yet profit was surprisingly positive, and he pressed again on the Q4 profit drop.
So the company's response clarified that a drop in methionine volume is what lowered overall sales revenue.
But that's a bulk additive, right?
Exactly. So it didn't severely impact profit. The real profit driver was crop protection chemicals, which did exceptionally well in Japan and India. They have much better margins.
Right.
And they reiterated that Q3 looked so profitable because of the advanced shipments, the Q4 orders pulled forward. So Q4 will logically see a decline due to this pull forward effect and expected lower sales prices.
It all comes down to the product mix.
Yeah.
Okay, question 4. The analyst is Mr. Umebayashi from Daiwa Securities. A brief summary of his question. Shifting to essential and green materials, he asked about the massive 51 billion yen profit improvement from Q2 to Q3. He wanted to confirm the impact of the Petrorabia share sales, the equity method percentage changes, and whether Q4 would see inventory buildup from periodic maintenance.
The company's response confirmed that roughly 50 billion yen of that improvement came directly from the Petrorabia equity sales.
Almost a whole amount.
Yeah, it was a massive move. Their equity method interest will drop from 37.5% to 15% in Q4. But beyond the sale, the underlying business improved too. Refining margins were better, and profit margins at their Singapore subsidiary, TPC, improved.
And the maintenance issue.
Furthermore, Petrorabia production and sales normalized in Q3 after being impacted by Q2 plant maintenance.
Excellent. Okay, halfway through the Q&A, question 5. The analyst is Mr. Okazaki from Nomura Securities. A brief summary of his question is that he asked for clarity on the dividend policy. He specifically noted the jump to a 40% payout ratio, up from a historical 30%, and asked if the 7.5 yen dividend is the new baseline moving forward.
The company's response reaffirmed its policy of providing a stable dividend. While they usually target a 30% payout ratio, profits are currently in a recovery phase.
Right, they aren't back to normal yet.
Exactly. To maintain a stable minimum dividend for shareholders during this recovery, the ratio naturally bumped up to 40%. They confirmed that they currently view the 7.5 yen mark as a minimum baseline to maintain, though future payouts will depend on next year's performance.
Okay, question 6. This is the analyst, Mr. Watabe, from Morgan Stanley MUFG Securities, with his second question. A brief summary of his question. He dug deeper into the essential and green materials divestment gains, which totaled 55.8 billion yen. He asked if the segment would be in the red without those gains, asked for details on the concentrated non-recurring losses expected in Q4, and whether lower depreciation would help next year.
The company's response clarified that the 55.8 billion yen divestment gain actually included Petrorabia and the previously disclosed Nippon A&L sale.
Okay, that makes sense.
Regarding Q4, they confirmed that planned restructuring items and impairments, the non-recurring losses, will be concentrated there. They also confirmed that there should be a positive impact next fiscal year from a decline in depreciation, though they couldn't give full budget details yet.
Just ripping the Band-Aid off now so next year looks cleaner. All right, final question. Question 7. The analyst is Mr. Yamada from Mizuho Securities, also with a second question. A brief summary of his question. He asked about the others, or corporate expenses category. He specifically noted the expected Q4 negative figures and asked if R&D expenses of 20 to 25 billion yen should be expected from next year onwards.
The company's response explained that massive R&D expenses are housed here, specifically over 10 billion yen dedicated to regenerative cell research.
Wow, just on regenerative cells.
Yeah. Because these developmental expenses are hard to project evenly, they often surface heavily in specific quarters like Q4, and they noted that they do not expect these costs to drop significantly next year. They will maintain a high level of investment in this research.
Okay, let's zoom out for a high-level wrap-up.
If we synthesize the main themes of the entire call for you, this is fundamentally a story of a major company successfully executing a turnaround through fundamental structural reforms.
Right.
The massive profit jumps were fueled by strategic divestments like Petro Rabi and incredibly strong pharma sales.
And it is important to add that while the short term looks great with those upward revisions and increased dividends, Sumitomo Chemical is actively cleaning house in Q4 by absorbing those planned restructuring costs and impairments.
Which really leaves you with a provocative thought to ponder. How does a legacy chemical giant balance its traditional industrial restructuring with massive future-facing bets?
It's a huge pivot.
They are trimming the fat in petrochemicals while pouring tens of billions of yen into cutting-edge regenerative cell research. Will this aggressive pivot completely redefine what kind of company Sumitomo is in the next decade?
It is going to be fascinating to watch. Well, thank you all for watching the video. If you like the video, we suggest you click like, share the video, subscribe, and stay tuned for upcoming content. Thanks again.